All right, let's face it, tax season can be a lot. It's
Yeah.
already complicated enough.
Uh-huh.
And then life happens, maybe a divorce, a separation, and suddenly those tax forms feel, well, impossible.
Yeah, absolutely daunting. But that's why we're diving deep today.
Exactly. Our mission is to slice through the complexity of IRS Publication 504 for you.
Think of this as your shortcut. We'll break down the key rules, uncover maybe some surprising details, and really focus on those tax-saving strategies.
We're zeroing in on how you file taxes when you're divorced or separated. We'll go item by item, always looking for ways to, keep more money in your pocket.
We've got the IRS guidance right here, and we're ready to walk you through it. We'll flag what's crucial so you feel informed, not overwhelmed, ready to jump in.
Let's do it. Okay, first stop,
Yeah.
filing status. This seems like ground zero for everything else, especially tax saving.
And it absolutely is. Your filing status dictates, well, basically everything. If you
Yeah.
even need to file your standard deduction
Yeah.
amount, which credits you might qualify for.
And the key date is
The last day of your tax year, December 31st, that's the snapshot the IRS takes. Your marital status on that one day determines your status for the whole year.
so even if you got divorced on, say, December 30th.
Yep. For that entire tax year, you're considered unmarried.
Okay, so what does unmarried mean in IRS terms?
It means you have a final decree of divorce or separate maintenance by December 31st. Or an annulment decree.
Annulment's a bit different though, right?
It is. An annulment basically says the marriage never legally existed. So if that happens, you'd likely need to go back and amend prior year tax returns with Form 1040X for any open tax years where you filed as married.
Ah, okay. Now, I heard there's a tricky exception here. Something about divorcing just for taxes.
Oh yeah, the intent to remarry exception. If you divorce late in the year purely, and I mean purely to get a tax benefit, and you intend to remarry that same person early the next year,
The IRS sees through that.
they do. They'll say you must file as married for the year you got the tax divorce.
Yeah.
It's a bit of an anti-abuse rule.
Good to know. So what if you're separated, but don't have that final decree by year end?
Then you're still considered married for the whole tax year. And just a quick side note, registered domestic partnerships or civil unions. Generally not considered married for federal tax purposes.
But wait, even if you are technically married, there's a potential game changer, right? A big tax saving opportunity.
Yes, this is huge. Even if legally married, if you meet certain requirements for living apart, you might be considered unmarried,
And that lets you file as?
head of household,
Bleh.
which usually means a lower tax rate and a much higher standard deduction compared to married filing separately. A major win.
Definitely something to look into.
And one more heads up related to status changes, the premium tax credit for health insurance.
Ah, from the marketplace.
Exactly. If your marital status, income, or family size changes, you need to report that to the marketplace pronto. It affects your eligibility and the amount of financial assistance.
Otherwise, you could have issues when you file Form 8962 to reconcile the credit.
Precisely. And if you divorced, but were on the same health plan for part of the year, you'll need to carefully allocate the policy amounts on your separate returns. It gets detailed.
Okay, let's move to married filing jointly. Often the default for married couples.
Right. You combine everything, income, deductions, credits, onto one return. Doesn't matter if one spouse had zero income.
But here's a pro tip for saving money.
Always. If both spouses have income, you should always run the numbers both ways. Married filing jointly and married filing separately.
Just to see which one gives you the lower overall tax.
Exactly. It takes a little extra time, maybe some software clicks, but it can definitely pay off. Don't just assume joint is better.
It makes sense. Now, liability on a joint return. This is important.
Crucial. When you file jointly, both spouses are jointly and individually responsible for all the tax, interest, and penalties.
Even if only one spouse earned the income. Or even if your divorce decree says the other person is responsible.
Correct. The IRS can still come after either one of you for the full amount. Your agreement doesn't bind the IRS.
Wow. So what if you get stuck holding the bag for your ex's tax mess on a joint return? Is there any recourse?
Yes, thankfully. There's relief from joint liability. The IRS has three main types: innocent spouse relief, separation of liability, and equitable relief.
And you'd use Form 8857 for that.
That's the one. And Publication 971 goes into all the details. It's a safety net, but you have to meet specific conditions.
And then there's injured spouse relief. Sounds similar, but it's different.
Very different and important to distinguish. Injured spouse relief isn't about tax mistakes on the return. It's when your joint refund gets taken to pay your spouse's past due debts.
Like old student loans or back child support.
Exactly. Or past due taxes they owed from before you were married, maybe state taxes.
Hmm.
Form 8379 is what you file to get your share of that refund back.
So two different forms for two different problems.
Got
Yeah.
it. Key distinction.
Okay, what about married filing separately? Sometimes necessary, but you hinted it's often more expensive. Why is that?
Well, you're only responsible for your own tax, which can be appealing. But the downsides are pretty significant, especially if you're focused on tax savings.
Like what? Higher tax rate.
Generally, yes. The tax brackets are less favorable, your alternative minimum tax, or AMT exemption, is cut in half, and a lot of valuable credits get slashed or eliminated.
Which one specifically?
Big ones, like the credit for child and dependent care expenses, usually gone if you file separately. The exclusion for employer-provided dependent care, halved down to $2,500.
Ouch. What else?
You typically can't take the earned income credit unless you meet specific rules with a qualifying child. No adoption credit. No exclusion for savings bond interest used for education.
And if you lived with your spouse at any point during the year?
Even more limitations kick in. No credit for the elderly or disabled. More of your Social Security benefits can become taxable up to 85%.
Wow.
Lower income limits for the child tax credit and a retirement savings contributions credit. And your capital loss deduction limit is $1,500 instead of $3,000.
Okay, this next one sounds like a major trap. The itemizing rule.
This is the big kicker for married filing separately. If one spouse itemizes their deductions, maybe they have high medical bills or state taxes, the other spouse cannot take the standard deduction.
They must itemize too, even if they have hardly anything to deduct.
Correct. Even if their itemized deductions are zero or way less than the standard deduction would have been, it forces them to itemize, which often means a higher tax bill.
And dividing those itemized deductions gets specific.
Vary, like medical expenses paid from a joint account. You'd generally deduct half. Property taxes on a home owned as tenants by the entirety. You only deduct what you personally paid. Same for mortgage interest in that situation. Depends on ownership and who paid. Table 1 in Pub 504 breaks this down.
Okay. And if you file separately, can you change your mind later and file jointly?
Yes, usually. You generally have 3 years from the original due date to amend from separate returns to a joint return using Form 1040X.
But you can't go the other way, from joint to separate.
Generally, no. Once the tax filing deadline passes, you're locked into that joint return. There's a very narrow exception involving the death of a spouse, but for most people, it's a one-way street from separate to joint, not the other way around.
Good to know. All right, let's switch to a potentially much better option, head of household. If you qualify, this sounds like a major tax advantage.
It really is. The benefits are significant. First, you can claim the standard deduction even if your spouse itemizes, assuming you qualify as considered unmarried.
Which we'll get to. What else?
Your standard deduction is higher than single or married filing separately. Your tax rates are generally lower. And you unlock eligibility for credits you lose when filing separately, like the dependent care credit.
Higher income limits for things like a child tax credit, too.
Yes, exactly. So overall, it can lead to substantial tax savings.
Okay, so what are the main requirements to get this status?
3 key things.
Yeah.
1, you have to be unmarried or considered unmarried on December 31st. 2, you must have paid more than half the cost of keeping up your home for the year.
And 3.
A qualifying person must have lived with you in that home for more than half the year. There are some exceptions, but that's the general rule.
Let's unpack considered unmarried. That sounds like a bit of tax magic. How does that work if you're still legally married?
It does feel a bit like that.
Yeah.
You qualify if you file a separate return, you paid more than half the cost of keeping up your home, and this is crucial. Your spouse did not live in your home during the last 6 months of the tax year.
Last 6 months. What about temporary absences, like if they were away for work or school?
Temporary absences for special circumstances like illness, education, business, vacation, military service, those usually count as living together. So it has to be a real separation for that last half of the year.
And there's a child requirement, too.
Yes. Your home must have been the main home for your child, stepchild, or foster child for more than half the year, and you must be able to claim that child as a dependent. Or you could claim them, except you let the non-custodial parent claim them using that Form 8332 we'll talk about.
Okay. And keeping up a home, what costs actually count towards that more than half test?
Think basic living expenses for the home itself. Rent, mortgage interest, property taxes, home insurance, repairs, utilities like gas and electric, even food eaten in the home.
What doesn't count?
Personal expenses. Clothing, Education costs for family members, medical treatments, vacations, life insurance premiums, transportation, none of that counts towards keeping up the home.
Got it. Now, the qualifying person part, you mentioned exceptions. Is there a big one?
Yes, a really important one for parents. If your qualifying person is your dependent parent, they don't actually have to live with you.
Really? How does that work?
You still have to be able to claim them as a dependent, but the key is you must have paid more than half the cost of keeping up their main home for the entire year. That home could be their own house, an apartment, even a nursing home.
That's a huge exception. So if you're supporting a parent financially, even if they live elsewhere, you might still qualify for head of household.
Absolutely. It's a significant benefit many people overlook. The rules also cover situations like if the qualifying person was born or died during the year, or temporary absences again.
Okay, shifting to dependents. Claiming dependents unlocks a lot of tax benefits, so getting this right is crucial.
Absolutely. The IRS has two main categories, a qualifying child and a qualifying relative. Who fits into which category determines eligibility for things like the child tax credit, the credit for other dependents, and more.
And this gets especially complex for children of divorced or separated parents, right? Who gets to claim the child?
Yes, this is a very common area of confusion and potential conflict. The general rule revolves around who is the custodial parent.
And how is that determined?
It's based on where the child lived for the greater number of nights during the year. Count the nights. If it's equal, the parent with the higher adjusted gross income, AGI, is typically considered the custodial parent.
So the custodial parent usually gets to claim the child as a qualifying child.
That's the default, mainly because they usually meet the residency test.
But there's a major exception, a way the non-custodial parent can claim the child.
Yes, and this is a key tax planning tool. The non-custodial parent can treat the child as their qualifying child if four specific conditions are all met.
Okay, what are they?
1. The parents are divorced, legally separated, or lived apart for the last 6 months of the year. 2. The child received over half their support from the parents. 3. The child was in the custody of one or both parents for more than half the year.
And the fourth one is the big mechanism, right?
It is. The custodial parent must sign a written declaration saying they won't claim the child as a dependent. The most common way is using IRS Form 833-2, Release Revocation of Release of Claim to Exemption for Child by Custodial Parent.
And the non-custodial parent attaches that signed form to their tax return.
Exactly. For divorce or separation agreements executed after 2008, Form 833-2, or a statement with the exact same unconditional language is pretty much the only way. Pre-2009 agreements had a bit more flexibility.
Now, here's where it gets really interesting from a tax-saving perspective. What exactly does that Form 8332 transfer?
This is the critical insight. Signing Form 833-2 allows the non-custodial parent to claim the child for the dependency exemption, when it existed, the child tax credit, the additional child tax credit, and the credit for other dependents.
Okay, but what does it not transfer?
It does not transfer the ability to claim head of household filing status, the earned income credit, the child and dependent care credit, or the exclusion for dependent care benefits.
Whoa. So the custodial parent could sign Form 8332, letting the other parent get the child tax credit, but the custodial parent might still be able to file as head of household or claim the EIC based on that same child.
Precisely. This is a huge point. The benefits can essentially be split. The custodial parent gives up the dependency-related credits but potentially keeps eligibility for these other major benefits based on having the child live with them. Understanding this allows for much more strategic tax planning between the parents.
That is fascinating and incredibly important. Can the custodial parent ever take back that release?
Yes, they can revoke the release for future years by providing written notice or using Part 3 of Form 8332, but it generally doesn't take effect until the tax year after the year the notice is given.
Okay. What if, somehow, more than one person could claim the same child under the rules, like maybe a parent and a grandparent?
It happens, but only one person can actually claim the child for those key benefits. We mentioned child tax credit, head of household, EIC, dependent care. You can't split them multiple ways.
So the IRS has tiebreaker rules.
They do. If multiple people qualify, these rules decide who wins, generally. A parent wins over a non-parent. If both potential claimants are parents who don't file jointly, the child lived with longer wins.
What if they lived with each parent the same amount of time?
Then the parent with the higher AGI wins. If no parent can claim the child, the person with the highest AGI among the eligible non-parents wins.
So applying these rules, especially with that Form 8332 nuance, allows for some advanced strategies.
Absolutely.
Yeah.
You could have a situation where the non-custodial parent claims the child tax credit via Form 8332, but the custodial parent, or maybe even another relative who meets the rules,
Yeah.
still claims head of household or EIC based on that same child, thanks to the tiebreaker rules. It's complex but powerful.
Definitely requires careful planning.
Yeah.
Okay, let's pivot to alimony. This area has seen massive changes recently, right?
Huge changes. This is probably one of the biggest shifts impacting divorce taxation in decades.
Mm.
For any divorce or separation agreement executed after December 31st, 2018,
Yes.
alimony payments are no longer deductible by the person paying and no longer taxable income to the person receiving.
Wow, that completely flips the script on tax planning for alimony.
Completely. It also applies if you had a pre-2019 agreement but modified it after 2018, and the modification expressly states these new rules apply.
So for older agreements pre-2019 that haven't been modified like that, the old rules still stand?
Correct. Under the old rules, alimony is deductible by the payer and is taxable income to the recipient. So you have two completely different systems running concurrently depending on the date of the instrument.
So under either system, what actually counts as alimony? Is it just any payment between ex-spouses?
No, definitely not. It has to meet several tests. It must be a payment in cash or check money order, no property transfers or services.
Okay.
It has to be received by or on behalf of a spouse or former spouse under a divorce or separation instrument. The instrument itself can't designate the payment as not alimony.
So the agreement could specifically say these payments are not alimony.
Yes, if both parties agree.
Ah.
Also, if legally separated, the spouses generally can't live in the same household when the payment is made. There's a 1-month exception if one is preparing to leave.
Yeah.
And crucially, the liability to make payments must end upon the recipient spouse's death.
What if payments change or start because of the recipient's death, like life insurance proceeds?
Those are considered substitute payments, and generally not alimony. If a payment starts, increases, or accelerates due to the recipient's death, that points towards it not being true alimony.
Okay, so what are some common things that are definitely not alimony?
Child support is number one. Payments are always treated as child support first if there's an underpayment. Non-cash property settlements are not alimony. The recipient's share of community income isn't alimony.
What about paying expenses on the house the payer still owns?
Also not alimony. Payments to keep up the payer's property or payments for the use of the payer's property don't count.
But you mentioned payments on behalf of a spouse. Can payments to a third party count?
Yes, they absolutely can. If you make cash payments for your spouse's rent, mortgage, medical bills, tuition, or taxes directly to the provider, like the landlord or the hospital, those can qualify as alimony if all the other rules are met.
What about life insurance premiums?
Those can be alimony, but only if the recipient spouse owns the policy.
And expenses on a jointly owned home. This seems like a common, tricky area.
Very common. Table 4 in Pub 504 addresses this, mainly for those pre-2019 agreements where deductibility matters. For example, if you pay the mortgage on a home owned jointly as tenants in common, half the payment might be alimony. But if it's owned as tenants by the entirety or joint tenants, the treatment of mortgage and property tax payments can be different regarding what counts as alimony versus what's deductible as an itemized deduction. Ownership type is key.
Okay, this sounds like a minefield, especially under the old rules. I've heard of something called the alimony recapture rule. What's that about?
Recapture. Another complexity mainly for those pre-2019 agreements. It's designed to prevent front-loading alimony payments just to get a big deduction early on.
So if payments drop too much too quickly.
Exactly. If alimony payments decrease significantly within the first 3 calendar years after payments begin, the payer might have to recapture some of the previously deducted amount, meaning add it back into their income in the 3rd year.
And the recipient gets a corresponding deduction.
Yes, the recipient gets to deduct the amount the payer recaptures. It kicks in if payments decrease by more than $15,000 between certain years within that initial 3-year period.
Are there exceptions? What if the payments decrease because the recipient remarried or passed away?
Good question. Decreases due to the death of either spouse, the remarriage of the recipient, or temporary support orders generally don't trigger recapture.
Yeah.
Also, payments that fluctuate based on a business's income usually aren't subject to it. There's a worksheet, Worksheet 1, in POP 504 to figure it out.
Definitely sounds like something to be aware of if those older rules apply. Let's move on to handling assets, retirement accounts, and property. How does that work tax-wise?
A key tool here is the Qualified Domestic Relations Order, or QDRO. That's QDRO.
And that's specifically for retirement plans?
Yes. It's a judgment or order related to divorce that creates or recognizes the right of an alternate payee, usually a spouse, former spouse, child, or other dependents, to receive all or a portion of a participant's retirement plan benefits.
What are the tax consequences when benefits are paid out under a QDRO?
It depends on who receives the payment. If it's paid to a child or dependent, it's generally taxed to the plan participant, the employee's spouse.
Okay. But if it's paid to the spouse or former spouse?
Then it's generally taxed to the recipient's spouse or former spouse. And here's a big tax-saving opportunity. If the payment is an eligible rollover distribution, the receiving spouse can roll it over tax-free into their own IRA or another eligible retirement plan.
Deferring the tax until they take it out later.
Exactly. It avoids immediate taxation.
What about IRAs? Are they handled differently?
Yes, QDRO rules don't apply to IRAs, but you can transfer IRA assets tax-free to a spouse or former spouse if the transfer is made under a divorce or separation instrument.
So no tax hit on the transfer itself.
Correct. It's not considered a taxable distribution. Also, note that after a divorce, you generally can't deduct contributions made to your former spouse's traditional IRA. And for your own IRA contribution limit, only taxable alimony from those pre-2019 agreements counts as compensation. Post-2018 non-taxable alimony doesn't.
Okay, let's talk property settlements, transferring things like a house, car, investments. What's the general tax rule here? It seems like a big potential benefit.
It is a huge benefit. The general rule is that no gain or loss is recognized on a transfer of property from an individual to, or in trust for the benefit of, a spouse or a former spouse if the transfer is incident to the divorce.
So you don't have to pay taxes just because you transferred the house title to your ex as part of the settlement?
Generally, no. Even if you receive cash or other property in exchange, the transfer itself is usually tax-free for the transfer.
What does incident to divorce mean specifically?
It means the transfer happens within 1 year after the date the marriage ends, or it's related to the cessation of the marriage.
Related to the cessation, how long does that last?
A transfer is presumed related if it's pursuant to your divorce or separation instrument and occurs within 6 years after the marriage ends. Transfers outside that time frame might still qualify, but you need to show they were delayed for specific reasons like legal disputes or business problems.
What if you transfer property to a third party on behalf of your spouse or former spouse?
That's usually treated as 2 steps. First, a tax-free transfer from you to your spouse, former spouse, and then an immediate transfer from them to the third party. You generally don't recognize gain or loss, but your spouse, former spouse might, depending on the situation.
And providing records is important here.
Absolutely critical. The person transferring the property must give the recipient records needed to determine the adjusted basis and holding period of the property.
Because the recipient needs that for their future taxes, right?
Yeah.
Let's talk about basis. This seems key.
It's incredibly important for future tax planning. When you receive property incident to divorce, your basis in that property is the same as the transfer's adjusted basis was right before the transfer.
Regardless of the fair market value, even if you paid something for it.
Correct. You step into the shoes of the transfer. So if your ex transfers a house to you that they bought for $100,000, but it's now worth $300,000, your basis is still $100,000. That built-in gain transfers to you.
Meaning you'll be the one paying tax on that gain when you eventually sell.
Exactly. Understanding the basis is crucial for knowing your future tax liability.
What about gift tax? Can property settlements trigger gift tax?
Usually not between U.S. citizen spouses due to the unlimited marital deduction. For transfers to a former spouse, they generally are subject to gift tax unless they meet an exception.
Such as?
Transfers to settle marital support rights, transfers required by a divorce decree, or transfers under a written agreement if the divorce occurs within a specific 3-year window. Also, the annual gift exclusion, $18,000 for 2024 applies, and direct payments for tuition or medical care are generally exempt.
Okay, a really practical question. What about the costs of getting the divorce? Are legal fees deductible?
This is usually disappointing news. Generally, no. Legal fees and court costs for getting a divorce or separation are considered personal expenses and are not deductible.
Even fees specifically for tax advice related to the divorce, or fees to get alimony.
Correct. Those used to be deductible years ago, but tax law changes eliminated those deductions. Fees paid to appraisers or accountants related to figuring tax consequences or securing alimony are also generally not deductible.
So mostly non-deductible. Is there any tax silver lining related to those legal fees?
Yes, there is one important angle. While fees related to the divorce itself aren't deductible, legal fees you pay that are specifically for acquiring ownership of property as part of the settlement.
Like getting the house titled in your name?
Exactly. Those fees aren't deductible as an expense, but you can add them to the basis of the property you receive.
Ah, so it reduces your future taxable gain when you eventually sell that property.
Precisely. It's not an immediate deduction, but it provides a future tax benefit, a subtle but important tax-saving point.
What if you end up paying your spouse's legal fees?
Those are generally not deductible by you. They might be considered alimony under the old rules if they meet all the requirements, but otherwise they could be treated as a gift from you to your spouse, potentially triggering gift tax issues if the amount is large enough.
Okay, with all these changes, filing status, dependents, income updating tax withholding seems critical.
Absolutely essential. One of the first things you should do after a divorce or separation is file a new Form W-4, Employees Withholding Certificate, with your employer.
To make sure the right amount of tax is being withheld from your paychecks based on your new situation.
Exactly. Your old W-4, based on being married, is likely wrong now, and you could end up owing a lot or having way too much withheld.
And what if you have income that isn't subject to withholding, like that taxable alimony under the old rules or self-employment income?
Then you likely need to make estimated tax payments. You generally have to pay taxes as you earn income throughout the year.
And failing to do that can lead to penalties.
Yes, underpayment penalties can apply even if you get a refund when you file your return. The IRS wants you to pay relatively evenly throughout the year via withholding or estimated taxes.
What if you made joint estimated tax payments before the divorce, but now you're filing separate returns? How do you split those payments?
You and your former spouse can agree on how to divide them. If you agree, you can split them any way you like.
And if you can't agree?
Then the IRS has a specific formula. The joint payments are divided based on the proportion of the total tax shown on your separate returns.
Okay, last big topic, community property states. This adds another layer of complexity.
It certainly does. For listeners in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, special rules apply because state law treats most property acquired during marriage as owned equally by both spouses.
So if you live in one of those states and file separately,
You generally have to report half of all community income and all of your own separate income. You also each typically claim half the income tax withheld from community wages.
are there times when you don't split community income 50-50 for federal taxes?
Yes, the IRS might disregard community property laws in certain situations.
Hmm.
For instance, if one spouse acts as if they're solely entitled to an item of community income and fails to notify the other spouse about it before the tax return due date, that spouse might have to report all of that income.
And there's relief available too, similar to innocent spouse relief.
Yes, there's specific relief from liability for tax on community income if you meet certain conditions, like you didn't know about the income. There's also equitable relief based on fairness, considering factors like economic hardship or spousal abuse. These are important protections.
What if spouses in a community property state live apart for the entire year?
There are special rules that might apply. If you live apart all year, don't file jointly, and meet a few other conditions. Certain types of income are treated as the separate income of the spouse who earned or received it, effectively ignoring community property laws for those items.
Like wages or self-employment income.
Exactly. Also, things like separate property income and Social Security benefits. It simplifies things somewhat if you've been separated the whole year. Pub 555, community property, has all the details.
And community property also impacts alimony under those old rules.
It can. If you're dealing with pre-2019 alimony rules in a community property state, a payment is only considered alimony and thus deductible taxable to the extent it exceeds the recipient's spouse's share of community income. It's an extra calculation layer.
Wow. Okay, we've covered a huge amount of ground. It really highlights how understanding these tax nuances isn't just about following rules.
No, it's really about reclaiming some financial control and clarity during a challenging time.
And building a stronger foundation for your future, truly one informed tax decision at a time.
Well said. And while we've hit the major points from Publication 504, remember, every situation is unique. Definitely check irs.gov for the publication itself and the forms we mentioned, like 8332 for dependents, 8379 for injured spouse, 8857 for innocent spouse relief.
And if things feel too complicated, don't hesitate to get professional tax advice tailored specifically to you.
Always a good idea.
All right, that's our deep dive for today. Until next time, stay informed.